Hi, I'm Ed Lyon, Chief Tax Planner at Excel Empire, and today I'm here to educate you about the Augusta Rule. If you spent any time following business and financial videos on Instagram or TikTok, you've probably already run across it. There's one particularly entertaining TikTok where a consultant earning $7 million sitting in his Ferrari calls it the best financial advice he's ever received in his career. That's laughable, of course. The Augusta rule won't make a significant dent in a seven-figure taxable income, but it does show you how much tax professionals love discussing this strategy. So, Code Section 280AG says if you rent your residence for up to 14 days per year, you don't have to include that rent in your income. For years now, homeowners have taken advantage of this rule to pocket some tax free income when special events roll into town. It's called the Augusta Rule because if you live in Augusta, Georgia, and you're not a golf fan, you can rent your home to a bunch of overgrown frat boys rolling into town to watch the Masters golf tournament every year. The same principle works for similar events. If the Super Bowl or the Olympics or a national political convention come to town, and you can find someplace else to stay for a while, you can take advantage as well. The problem with all of those choices is they involve renting your home to strangers who may or may not respect your home the way you do. Fortunately, as you'll see in the language of Section 280AG, there's no requirement that you rent your home to strangers. That means you can rent your home to your business. Deduct the rental payment from the business like any other rent you'd pay and pocket the income tax free on your personal return. In other words, take the money out of one pocket where it's deductible and put it in another pocket where it's non taxable. Pretty neat, huh? Of course, there's a limit right there in Section 280AG 14 days. As with any other tax deductions, you're going to have to dot your I's and cross your T's to make it work. For starters, your business has to be taxed as a separate legal entity. That means it has to be taxed as a partnership or a corporation. From a tax perspective, a business taxed as a sole proprietorship, including a single member LLC, is indistinguishable from you, and you can't rent the house to yourself. The next requirement involves qualifying rental occasions. Code Section 274A1B, also known as the Entertainment Facility Rule, disallows deductions for facilities used for entertainment, recreation, or amusement. That means you can't rent your home to your business for plain old parties. However, there are still plenty of occasions you can host at home: annual shareholder and director meetings, offsite employee retreats, client events where any meal or entertainment you serve up are incidental to the client event as opposed to being the point of the event. I had one client years ago who was a real estate agent representing a small custom home builder. The builder didn't do enough business to justify building and maintaining a model home, but my client lived in one of the builder's homes. So once a month, my client rented his home to his LLC to hold an open house to show off the builder's work. That alone created 12 qualifying rental occasions. You also have to pay a fair market value for the rent. You can't just say your house is worth $5,000 a day and call it good. Remember, any business expense you deduct under Code Section 162 has to be ordinary and necessary. So, how do you determine that amount? You can go online, search through Airbnb listings, and see what comparable landlords are asking for their homes. You can call local meeting spaces to determine what they charge for similar space, but your best bet is probably to get a written appraisal from a qualified appraiser. That way, in the unlikely event you do get audited, you'll be able to show the auditor you made a good faith effort to determine a reasonable rental rate. Naturally, you have to document your deductions. You'll want to put together a lease agreement and document each single use of the home. In 2023, the tax court issued two opinions involving Augusta Rule deductions and disallowed rentals where the taxpayer had no specific basis for establishing the rental value they claimed. They also disallowed deductions where the homeowner hadn't documented the business use of the home. So be sure to show you've done some homework and you feel comfortable signing a tax return that deducts whatever amount you claim. If your business pays you more than $600 in rent, you should issue a 1099 to yourself. You'll include the payment in box one. Of course, now the IRS will know you're getting that income. How do you report it on your 1040 without paying tax? You'll include it on Schedule E, page 1, where you would report any other real estate rental. Drop the gross rent into line 1, then include the same amount on line 19 and note it as non-taxable under Code Section 280 AG. Voila, your net result is no taxable income. Here at Excel Empire, we present the Augusta Rule to nearly all our business owner clients. It won't make you rich, but it's a great door opener to the sort of comprehensive planning that really can save you a fortune. Thanks for joining me today and subscribe to our channel for more great tax strategies. And if you want to see how much you're overpaying, check out our tax reduction estimator at excelempire.com.